All right, hello everyone. Sorry for the delay. We had a few technical issues, but we're ready to start now. We have quite a good number of participants joining us for the first webinar of our GN-PBO series of webinars. My name is Ermal Vila. You've been getting a lot of emails from me. I am a part of the parliamentary strengthening cluster here at the World Bank. We are joined today by Mitch, who is our senior public sector senior governance specialist here at the bank and leading the parliamentary cluster, and also by our presenter Rajul, who has kindly offered to give this to kickstart this presentation, this series of webinars about the GN-PBO. Today Rajul is a senior public sector specialist in the governance global practice here at the bank, and he's part of what they call the global tax team here in the governance global practice. And we will actually get started pretty quickly. We'll just have Mitch say a few words, and then we'll just start with the presentation. And then after the presentation from Rajul, we're going to have some time for questions and answers. As you can see from your screens, there is a chat box. So while you're listening to the presentation, please send your questions through the chat box and your questions, and then Rajul will try to answer them in the remaining of the time. So Mitch, over to you.
Great, thanks, Emma. I won't take very much time. I just wanted to make sure that for those new participants to the conversation, that they understood the context in which we're having the discussion. You may have seen on ePBO that there is a draft framework that has been developed by the GN-PBO working group on budget analysis that looks at different elements or functions around the broader topic of budget analysis undertaken by PBOs. One of the topics that came up and was reinforced during discussions at the last GN-PBO assembly last June was the interest in having a better understanding around tax policy analysis. Now, it's a huge topic. From a Parliament side, what we were concerned by is that we had the start of a conversation happening within the parliamentary community, and what we wanted to make sure that we did was twofold. First off, make sure that we all learned from each other as to what we were doing and what we thought were what was the best path forward, but also had a better understanding as to the type of the way in which tax policy analysis was being undertaken on the government side, so as to be able to make sure that we were, talking the same language. Otherwise, that debate between Parliament and the government is not going to be based on kind of a similar type of analysis, and be very difficult for you to be able to ensure that your MPs are empowered to have that sort of policy debate with their government counterparts. So the purpose of today's webinar is really to be able to tap into the depth of kind of knowledge we have here in the bank around this particular topic, to get a better understanding as to some of the methodologies and approaches to tax analysis that are presently being used by government counterparts, to learn from you as to the type of tax policy analysis approaches that you've been deploying within your own PBOs. If you have any technical questions that you want to lob to Rajul, he's more than happy to take those during the presentation or after during the Q&A session. But we're also interested to hear from you and to gauge your interest in the different methodologies, and to hear from you whether or not those methodologies align with the types of requests and demands that you're receiving from your MPs. And that way, we as a kind of a global PBO community are going to be better placed to say, right, well, this is the types of analytic approaches that we should be taking in order to be able to bolster So at that point, I think that I hand over to the person who knows what he's talking about it.
Thanks a lot. Thanks, Ermal. Thanks for this great opportunity. I'm really excited. I think it's very exciting for me because I worked in the government of India with the Minister of Finance for 4.5 years, helping to where
Right, those people connecting in, could I ask that you mute your speakers if you would? We're just hearing some feedback here in DC, and I imagine some of the other participants would be as well.
well, so just to continue, I was involved in the preparation of several national budgets in India, and and then in the follow-up, when we were looking at the progress of the budgets during the course of the next year, we had lots of interactions with Parliament committees, particularly the Finance Committee and others, that would raise questions. And so I think I'm quite familiar with the process that you must be going through on your end on the Parliament committee side or the Parliament Budget Officer side. What I want to do today is really just give you sort of an introductory overview of the methodologies, the different methods available for analysis of tax policies and for essentially also for forecasting tax revenues. And, at some point I'll see how these are actually very closely related. So once you have the data and information for one, you can use that for the other. As I said, it's going to be a very introductory session. I don't want to go into great depth on anything, but I hope that this will help you get familiarized with the different methods available that are out there that are being used by tax policy wonks in ministries, and so hopefully that will help you in your own role in analyzing tax policies and preparing forecasts. So I just want to start with an acknowledgement. I got the most of the presentation is based on materials that I got from Professor Shukla from the Public Policy School at Duke University. They actually run a program on tax analysis and revenue forecasting, so I can quite confidently say this stuff is good. So, as I said, you start with what's the sort of the role of tax analysis, and then look into the objectives of revenue forecasting, all of this very quickly, and then go into some of the methods, the GDP-based methods, monthly receipts-based micro-simulation model-based methods, and so on. Now, this is the simplest form of a typical government budget. You've got expenditures, you've got revenues. On the expenditure side,
revenues, user fees. What is that, sorry? This is
so if you can please, hello everyone, can you please mute your mics? If you can mute your mics, and we'll take questions towards the end after the presentation is finished.
Thanks. So, on the expenditure side, as you know, there's the recurring expenditures, the revenue expenditures, as it's called, and then you have the capital expenditures. That's really the public investments that are made, and you have the transfers. On the revenue side, you have taxes, which is the main source of revenue for most governments. And then you have some other sources of revenue. You have the user fees, royalties, etc. You also have surpluses of state-owned enterprises. Of course, it could very well be deficits many times. So then that's a negative revenue source. And then you can raise money from the market. You can borrow through domestic or foreign loans and bonds. The point is, there's a lot of these, on the expenditure side, there's a lot that is very rigid, very hard. You have fixed administrative costs, salaries, etc., which cannot be, they're not flexible. You have lots of maintenance expenses. And if you don't pay attention to that, that leads to deterioration in public services. Transfers are statutory liability mostly. So you can, in the short run, borrow and sell assets, so like divesting from SOEs. But then, if there's too much borrowing, that's going to affect the risk rating of the country and inflation. So really, the point I'm trying to get to here is, for a sustainable, strong, well-managed fiscal policy regime, the base of it, the foundation, is a properly run tax system. And the better the tax system is run,
Can
the
sell
more
assets.
revenues
I guess
are raised in a way that is less and less growth inhibiting, which is a big challenge. Then, the government is well off. It can run, it can provide public services that populace demands. So now, that's the basic background that we are coming into from, and you know all of this stuff. So nothing new here. So in this context, what could be the role, what could be the function of a tax analysis unit or a parliament budget office unit looking at taxation? So one is, you would like to analyze the impact of alternative tax policies in terms of, what's the impact on revenue, what's the impact on tax incidence, where does it hit, which segment of the taxpayer population does the tax policy hit the most or benefit the most. So that's the one. Second is, non-tax policies would also have an impact on revenues. So, if you have strong public expenditure, government expenditure, for example, which increases investment and thereby growth, well, that's automatically going to lead to an increase in revenues. And we come to this when we look at the concepts of tax elasticity and tax buoyancy. And then you want to know what might be the revenue impact from macroeconomic changes, recession, or growth, or inflation, devaluation, changing trade patterns, and so on. Similarly, you want to have the ability to evaluate the impact of changes in economic conditions of other countries
So what's new
on your
here,
revenue.
which is not
This is a very important, given the globalized world that we live in today. This is very important. And finally, you want to be able to forecast for the future what's going to be the tax revenues. And of course, this is the focus of today's discussion. And linked to this, linked to the last point, measure the tax effort of the tax administration. So once you have a robust forecast of tax revenues, then you are in a much better position to judge whether the tax administration has done a good job in achieving the revenue targets. The caveat here, the revenue forecast must be a robust one, must be based on scientific methodologies. If you have an arbitrary revenue target and tax administration doesn't achieve it, well, then that's not a good thing. So, and that's one of the things that we want to sort of bring up today is what are the different methodologies that are available to scientifically forecast tax revenues. So then, these are, the objectives of revenue forecasting. First of all, a finance minister wants to know how much money is he or she going to have to spend on public investments, to spend on public services, to provide for maintenance, to service the debt, etc. So they need to know, how much am I going to have? So in the initiation of the annual budget process, the first number that the finance minister is looking for is, what's going to be the forecast? What's the forecast for tax revenues for the next year? So that's why it's the first, it's the initiation of the budget process. Given that, then you given that, and then given what's going to be the expenses that are going to be incurred, then there is a good estimate of the budget deficit for the future, because we all know it's basically revenue minus expenditure, or expenditure minus revenues, which is the deficit. As I said in the previous slide, we already talked about this, evaluating the revenue impacts from different economic factors, looking at the revenue impacts of policy changes, looking at the effect of inflation on revenues, and then measuring the tax effort of tax administration. So all of these are the objectives of forecasting revenues. So we come to the techniques. What I've done here is I've tried to bring into this presentation most of the commonly used methods. Now, they could be different for different taxes. You could use a different, and we'll come to this as we go along in the presentation. Some countries may use different methods because of the constraints of data that's available. Because as we see, you do need to have reliable data both at the national accounts level and at the level of the tax administration to be able to use it for some of these methods. And then, you need to, what I wanted to highlight again, and I've said it before, the more scientific, the more data-based, the more accurate our forecasts, the better sense we have of the actual impact of different policy changes, of different macroeconomic changes, and the better we are placed to measure the performance of tax administrations. So this bears repeating again. Okay, so GDP-based estimating models, as it's clear from the term, this is sort of a top-down approach. So you start with the GDP numbers, which are again a forecast or an estimate of what's likely to happen next year, but we start from that. And then we forecast aggregate tax revenues as a function of tax bases. So what we need to do here is estimate the elasticity of tax revenues using regression analysis. So just in case these terms are a bit sound technical, they are technical, but we are going to talk about tax elasticity and tax buoyancy, two concepts that are critical for understanding how to forecast tax revenues using this model. I'm assuming that we all understand, what's regression analysis. It's basically creating a function or a relationship between two sets of variables, one which is the one that we are trying to determine, and the others that are available in the form of data to us. So tax elasticity and tax buoyancy are two terms that you must have heard a lot. They are closely related, but they're quite different. So very simply speaking, a buoyancy of a tax system relates to the ability of a tax system or a tax regime to grow in terms of the amount of revenue that generates with the growth in GDP and other tax policy changes or other changes that are taking place. Tax elasticity is trying to separate out factors such as changes in tax rates or tax bases, and to look at what's given if we were to have the same tax regime, the same tax bases, the same tax rates, everything the same, given a growth in GDP or other tax bases, what's going to be the growth in tax revenues? So this is, again, repeating this and putting it out sort of more formally. Tax buoyancy is the ratio of the percentage change in tax revenues, including changes in tax collection due to changes in the tax base or the tax rate. which is the discretionary changes in tax policy, to the percentage change in GDP. Okay, and we'll come to a simple numerical example to illustrate this. So let's say that the tax revenue in year 0 is 20 million, and the next year it's 21 million. So this is actual, we observe this. GDP in the year 0 was 100 million, and then in the year 1 is 104 million. So there's an increase of 4 million in the GDP, which is 4%. There's an increase in 1 million on a base of 20 million in the tax revenue, which is 5%. So given this, 5 over 4 is 1.25. So the tax buoyancy is 1.25. Now, remember that we said this is actual observed fact. So there could have been changes in the tax regime, in tax policy. There could have been changes in the tax base. For example, some tax exemptions could have been removed. Some new taxpayers could have been added to the base, etc. All of that has happened. So this is simply tax buoyancy. What's the increase in? So this given that it's 1.25 here, for every 1% increase in GDP, the tax revenue will increase by 1.25%. So that's tax buoyancy. Elasticity is a little bit more complex, but this is the one we need to get to be able to really forecast revenues. So here we exclude the discretionary changes in the tax rate or the tax base. Okay. So here what we have to do is tax elasticity would be defined as the percentage change in tax collections over the percentage change in GDP. But here the tax collections, the changes brought about by policy have to be excluded. And we'll come to practical aspects of it because it is possible, quite possible, to segregate out the policy-related changes or the discretionary changes. So again, if we go back to that example, right, we had the change in tax collection was 5% on a GDP change of 4%. Now, suppose we know, we get from the data that's available, the information that's available, that the effect of the change of the tax rate and the base, which has come about due to policy changes, is 1.2%. Then the percentage change in tax, or T1 here we're calling it, which is the percentage change in tax revenue, if no changes had been made in the base of the rate, is 3.8%, right? 5% minus 1.2. Then here the tax elasticity is 3.8% over 4%, which is 0.95. So what are we saying? We're saying that we have, in this example, we have buoyancy of 1.25%, which came about partly due to changes in the tax rate and the tax base, which are policy induced. But the core tax elasticity is 3.8%, which is what is coming about. This is the amount of increase in taxation, tax collection that you're going to get even if you did not do any changes in policy or in tax base or tax rate. Okay? So this is the concept of tax elasticity, and we need to use this for calculating and for forecasting revenues. Now, there's 2-3 slides I want to come back to later because I want to continue with the forecasting and the calculation of the. So, what we need to do is we need to practically do this, to practically implement this. We need to construct data series for each tax, and we can do this for the main taxes, right? The corporate income tax, personal income tax, the VAT. These are the three main taxes in most countries. So here we need to do do a data series for tax revenues and tax bases. Now, where do you get the tax revenues? Obviously from the tax administration. And you have the numbers for year after year after year. This is the actual taxes collected. Now, so that's straightforward. That's simple. It's easily available. The tax bases actually need to be worked out for the different taxes. And that's where we'll go into that in a bit of detail, because that's where, given the fact that we don't have straightforward, simple tax policies in most countries, there's a plethora of exemptions, tax breaks, tax incentives, multiple rates, brackets, etc. Because of that, the calculation of the tax base is always a complicated exercise. But it's not impossible to do, obviously. Now, remember that for elasticity, we want to look at the tax revenues excluding any changes brought about by policy. Now, one practical tip here. So normally, the budget speeches of finance ministers provide estimates of the revenue impact of tax policy changes. They will say, because they are presenting before Parliament usually, so they'll say, I'm making this change, I'm eliminating this exemption, and this is positive to the tax revenue by X amount. Or they'll say, I'm giving this break to, this segment of taxpayers, and this is costing my tax revenue collections by Y amount. So usually that's where we find and we can obtain the tax impact of policy changes. So these are available, but they need to be culled out from the budget speeches and information that's available on record, in fact, in parliaments. Okay. Now, what we need to do is, for each of these taxes, we identify the best tax base proxy. Okay. Now, for personal income tax, what is personal? It's imposed on wages, salary, bonuses, interest, dividends, etc. Now, this is available in the national income accounts. In the case of VAT, what we need to do is we need to look at consumption. Because it's a consumption tax. It's a tax on consumption. Now, again, and we'll still go into more detail. So this is just to give an overview. But that's the basic point. There you're looking at income, personal income, private income, available in national income accounts. Here for VAT, you're looking at consumption data. And then, but the broad approximation, which is very good for, especially for personal income tax and corporate income tax, is GDP. It's the second best base, but we can use it. And if we use that over a period of years, well, then at least you have a trend that you can discern from it. But it won't be an accurate estimate. So what do we need to do? As I said, this is the regression analysis equation. Basically, adjusted tax revenues are going to be, or your forecasted tax revenues are going to be this function, where b, the small b here, is what is to be estimated. And this, if we take this in the log form, is directly going to give us the tax elasticity. Now, if the base that we're using, B1, is income, then what we get here, the small b1, is going to be the tax elasticity of personal income tax. If you're using consumption, then we're going to get, what we're going to get is going to be the tax elasticity of the VAT or the sales tax. Okay, now come back to the example that we had earlier. What will we do? To estimate tax revenue of next year, we're going to get this tax elasticity number that we got from our regression analysis. We multiply that by the percentage change in base. We add 1 to it, and then we multiply that by the tax revenue this year. So just go back to that example where we had calculated that our tax elasticity was 0.95 and that our percentage change in base, which was GDP, in that example was 4%. So 0.95 times 0.04 is 0.038. 1 plus that is 1.038. So 1.038 times 20, which was the tax revenue of year 0, we get 20.76. I wish I put this on the slide. I'm sorry I didn't. But so what we were getting is 21 million was the tax forecast using the tax buoyancy number, which was 1.25. The tax elasticity is 0.95 as per that example. And so the tax revenue forecast without any changes in policy, which means no change in rate, no change in base, would be 20.76 million. Okay? So this is the way we would use tax elasticity for forecasting revenue. Now, based on this, then you look at the finance minister's speech and say, okay, he's proposing this, which is going to increase revenues, proposing that, which is going to reduce, and you actually come up with a pretty accurate and good forecast. And this number, this tax elasticity, is something that is generated based on a data series that is available, as I said, the last several years. Okay. I want to quickly go into, and this is going to be quite quick, monthly receipts model, which is basically trying to look at month by month tax collection data. And as you all know, for finance ministers, the cash management is critical. They need to know what are they getting almost on a daily basis. So they need to know what's their expected forecast for month by month. And usually this is done by looking at the actual growth. So let's say the fiscal year starts January, we are on the 3rd of April now. What has been collected in the first quarter of the year until March 31 compared to what was collected in the first quarter last year? That gives us a growth number. We also have a projected growth of tax base, proxy, let's say GDP. And if we apply them to each other, then we get some sort of a forecast for the future months. So, yeah. So here we have it. We have the actual growth of year-to-date receipts over that of the same months in the previous fiscal year, and then the expected growth rate of tax-based proxies in the second fiscal year. We use these together to try to get a forecast of the coming months. This is very approximate. Okay, there could be so many things that will happen in the next month which would completely change this forecast. There could be a natural disaster. There could be external factors, recession, inflation, devaluation, etc., which could have an impact on these forecasts. But still, it's a rough and ready way of trying to come up with some forecasts. Now, coming to these micro simulation models, and you'll see as we go along in this that some of the work that we do here is actually relevant also for working out the tax bases in our GDP base model. So what this is trying to do is you start from, you estimate the VAT base let's say we're talking about VAT first, you estimate the VAT base as accurately as you can, and we'll see how that's done. You subtract exports, add imports, and then you exclude wages and salaries paid to public servants, etc. And then you come to this sort of accurate base. And this accurate base, actually, if you remember, going back to the GDP-based tax elasticity-based model, is very useful if you want to do an accurate regression to calculate, to come to the tax elasticity number. But the other point is, this is also very useful for you when you want to come to a number of what is the gap, what is the VAT gap, or the corporate income tax gap, which is the amount that the model predicts that would be collected, or that should be collected, versus what is actually collected. So that gap is usually attributed to the performance of the tax administration and the compliance behavior of taxpayers. Okay, these are the two factors. So it's a compliance gap or the administration effort gap. So again, once we have a very good estimate of this base, you will be in a position to question and to ask questions related to the administration, etc. So, how do you estimate the VAT base? Okay, this is basically the items that you would subtract. You start with GDP, which is consumption plus capital formation plus government expenditure plus the trade balance, export by imports. And then you subtract from this the trade balance, the gross capital formation because investment, wages and salaries, zero rated, that means consumption expenditures which are which don't attract VAT, those exempt consumption expenditures as well. Other items based on the VAT regime in the country. Okay. And then you add the inputs which are purchased by exempt sectors because they have embedded in them VAT that has been paid by earlier sellers and new residential construction. I mean, this is generally sort of the way to estimate the VAT base under this approach. And here, not to go into this too much, but just to say that each of these things, you will find this data in the national income accounts. So it's not difficult to get this data. That's important. So then let's just go on very quickly to the input-output approach. This is more of a bottom-up approach. Now this depends on the availability of input-output tables in countries. Most countries now have this kind of data, but we need to look at how accurate, reliable, and usable that data is, in what form it's available. But once we have that, we can actually, again, come up with a very sound estimate of the VAT base. So, not to go into this again in too much detail, but just to say that it's another way of really estimating the base, which is going to be useful for them estimating the actual amount of VAT that's likely to be collected. So, there's a lot of data requirements for this methodology. So not to go into that in too much detail, but I've put the slides out there so that for your reference. And again, this lists where the data is likely to be available and how the input-output table would be used, and then what data would be available from the tax administration. So here there's a lot of work that needs to be done to come up with the accuracy of the base. And finally, I'm going to just quickly go over the micro simulation models. Very useful for, in fact, largely used for personal income tax. these are, you create a typical, the model of a typical taxpayer. What would be the tax liability of a typical individual or a family? And you can use this, you can work this out based on annual income tax returns, but also based on household surveys, because there are some individuals who will not be, who fall below the tax threshold, and so they're non-filers, or they could be above the threshold, tax threshold, but are not filing. So this micro simulation model is useful in personal income tax. And then if you have a forecast, you would take a sampling process, and the revenues are forecast based on expected growth of population, income, etc. As I said, most useful in personal income tax, could be used for corporate income tax, but it's very difficult to create sort of a profile of a company which can be used for forecasting. Finally, you could also look at forecasting trade tax revenues, that is revenues from tariffs. The methodology would be very similar to the tax elasticity methodology we discussed, where you would use the tariff revenue elasticity. You would compute the tariff revenue elasticity using a regression analysis, regressing the real tariff revenues with respect to real imports, just like we did with GDP, and then use this formula, revenue this year times 1 plus the tax elasticity times the percentage change in imports to get revenue forecast for next year. And that's exactly what the formula would be. So I'm going to stop here, and it's been a quick, maybe not so quick, but as quick as it was possible, run through of the different methods, and very happy to take a few questions, or you can even, the email is here on the, and you can send me an email if you have a specific question. Thanks.
Brilliant. Thank you, Rachel. So we'll open it up to any, if you have any technical or specific questions about the presentation or the methodologies, and also your general feedback about whether there is alignment around these methodologies and what you're presently doing, or if it would align with the demands that you're receiving from your parliament. We'd also be interested to hear whether or not you might be using multiple methodologies to be able to do the type of analysis that might be requested by differential committees. I'm just noticing in the presentation that some of the analysis would be very relevant to the work of, say, a finance and budget committee.
Yeah.
Some of it would actually be quite relevant to those who are those committees monitoring execution of the budget, or even ex post, like public accounts committees. And there's definitely some correlations between what you have just presented and some of the work the GN-PBO has already done around costing of bills and costing of proposals. So exploring those linkages, I think, would be very beneficial to the community as well. But shall we open it up to the floor? We've got Amal here who's going to be able to help us navigate the technology.
Okay, yeah, all right. So we have a few questions. So one of them is from Rashad. He's asking, can Raju please explain again the growth adjustment factor weighted with the two components?
Yeah. Okay. So this is one of the methods that I don't really understand very well. Although when I was working with the finance minister in India, I used to use this sort of a crude method, where you basically look at what's the revenue. Let's say, as I said, end of quarter one, and let's say it's growing at 5% over last year. So I would say that so the trend for this year's revenue growth is 5%. But there's a forecast of GDP to be growing also at 5%. So what I would then do is, I would say, going forward, there's a likelihood that revenues might grow at 5%, and another factor of 5%, excuse me, of 5%. So it's a very rough and ready measure. But the idea is it's giving you some sort of a trend of what's likely to be the growth in the monthly receipts going forward. I don't know if that helps. But if there's a more detail needed, what I can try to do is you can send me an email and I'll be happy to send you like a note or something like that.
Yeah, so I think everyone is unmuted now. So if you have any questions, please, you can just send it to us directly. You can just ask Rajul directly.
Also, would be eager to hear from everyone as to the type of analysis that they might be doing within their own PBOs at the moment, or what the demands are from their MPs. They might not be doing it at the moment, but what are your MPs asking you for? Can you hear us, Phyllis? I think you might be on mute still, because we can't hear you.
Can you hear me now?
Yes.
Yes, perfect.
Yeah, thank you very much, and thank you for the presentation. It was good. Our concern as a PBO unit is the amount of data required, which sometimes a PBO unit may not have access to in order to update and run such a model from forecasting. And also the time it takes between the time the Minister of Finance submits his proposal and the time within which one has to update that model to be able to check the realism of the numbers from the executive. So what would you propose that PBO would build in advance so that it's able to do that?
So there's a question around the both the availability of the data and in circumstances sometimes you might have the government that doesn't even have the comprehensive data. So thinking about PBO access to the analysis of data upstream. Also, as an extension of your question, Phyllis, which I think is a good one, are there third-party sources of similar data that a PBO might be able to access in advance of getting that data from the government side?
So that's a reality. So I completely agree with that. I mean, this is a common problem we see across so many. So I would there's two approaches that we take. One is we can use the approximation of simply taking the GDP as a tax base and using that to try to forecast revenue. Now that's as I said, a second best method, but when you don't have the details of data, that's definitely worth using. But the point is, the estimation of the tax elasticity, it needs to be done once. But once it's done, it need not be done every year. It would still hold quite reasonably for at least the next 2 to 3 years. So if that exercise is able to be done once, at least for 1 or 2, at least for say 3 years, that same tax elasticity number can be used, the number that you obtain. So if there is the possibility of doing this exercise at least once in 3 years or 4 years, it's still worth it. Because then you have that number that you can use for, because the other data is available. Right? It's available from the records. Now, coming to some of the other methods like the input-output method, which needs a lot more data, that's not possible to do if you don't have that data. That's it's there's no two ways about that. So that's fine. I mean, so we don't have that level of accuracy, but we still have some measure which is better than having nothing at all. So that's sort of my answer to this.
So it might be a case of we've noticed that sometimes the government Euro budget might be a bit reticent to forward the basis for their analysis for the present kind of estimates and budget documents. But often they're a little bit more happy to do it for the budget previous. So if that data can be extrapolated over a 2 to 3 year basis, then maybe looking back at the budget previous and then bringing that forward in order to be able to test the veracity of the numbers the government puts forward in the present budget might be a PBO strategy.
Mm-hmm.
I think we have time to take another question or two. So if you don't, so there is another question here from Anthony. I'll just read it out loud for Raju as well. One frequently asked question is if the revenue forecast can be validated, particularly as the revenue agencies regularly report under the collection, particularly in the first quarter. What tools are there for smoothing forecasts from month to month?
Well, the point is that tax regimes have already built into them some things during the year. So, for example, companies for the corporate income tax need to pay advance taxes through the year, but in many countries these are not payable monthly. They're payable quarterly, and that, there will be different percentages that are needed to be paid every quarter. Some countries will have monthly payments. But so there are some things already built in. On the VAT, some countries allow small businesses to pay quarterly VAT, not every month. So there are going to be these things. We need to know, based on the tax regime, what's the ups and downs during the year. So there will be monthly variations. But the point is what you need to monitor, I guess, is given the trend in the past, what has been the pattern in the past years, is there any marked difference this year? And that pattern can actually be, can be obtained from the tax agency. That data is available. It's not a question. It's simply a question of getting the data and asking the tax agency to prepare that pattern and provide to you, which should be easy for them to do.
Yes. Yes. Hello. I think someone is trying to speak. Can you be a bit louder, please? So, one other question is, how do we estimate the impact of policy adjustments? For example, increase in payroll taxes or value-added tax. Does this require a micro simulation?
It depends, right? As I mentioned, the impact of changes would already be factored into and presented by the finance minister in their budgets. It's very rare for a finance minister not to say what's going to be the impact of the proposal. Now, there could be a view that the calculation that's been brought out by the finance minister could be wrong. I mean, it's possible that they might be overly optimistic in their, projection of the positive impact of a tax policy change and etc. But micro simulation models can be used, but it depends a lot on the data that's available. So if you have a change on the payroll tax, and if you have a good data set which provides the distribution of incomes with tax payments, over a period of years, then you have a very reliable data set, which then immediately lets you know if this is the change in payroll tax for this bracket of taxpayers, then you know how many taxpayers there are in that bracket. You know what's the likely behavior of that tax set of taxpayers, segment of taxpayers, and you can estimate it. So if you have a robust micro-simulation model for payroll taxes, yes, it will be very useful to work. For the VAT, if you have a good VAT base worked out through the input-output table methodology, then again, any change in the VAT which will have an impact on consumption of a particular sector would be easily and very well recorded through the input-output model. As I mentioned, the micro-simulation model doesn't really help much for the VAT.
All right, one more question. From Brandon, saying that I've noted that a combination of methodologies appear to be used in forecasting revenue. Assuming a country with good data as far as national accounts are concerned, what combination of methodologies and for which tax bases would you recommend?
So, as I mentioned, right, I think the input-output methods are very good, but if you don't have the input-output tables, then the methods where you estimate the VAT bases accurately, the VAT base accurately using national income account, starting from the GDP and subtracting and adding certain elements to come to a real VAT tax base. That really works very well. For personal income tax, the micro-simulation models tend to work well. For corporate income tax, the GDP-based model works well. So, yeah, there's a range of different models out there. We can choose one over the other for different tax instruments. And a combination would probably work well. But as I said, if there's not that much data available, then we can go with GDP as a base, especially for personal income tax and GDP.
Great. Maybe as a follow-up, because I think that question leads very quite smoothly into what it is we were hoping to do as the next step. We're very interested to hear from you as to what type of analysis you're presently doing, and also the type of analysis, even if you're not doing it at the moment, you think would most likely allow you to respond to demands from your parliamentarians. So what we could do is send around a survey monkey or survey, just listing out some of the different methods for you to be able to provide just a quick response saying we use this one or we like this one. And then a box at the end in case we haven't captured all the different methodologies that you might be using, that you could just type in and say, we're actually using this method at the moment, and it's working well, or it's not working well for us for this reason. That way we can get an idea as to what you're presently doing, but also the direction that you would like to be moving in, and then we can make sure that we can connect that knowledge and experience either from a governmental side or from other PBOs in order to be able to meet your information and knowledge needs. Would that work?
Yes.
I'm seeing some happy faces, so this is good.
Great. So I think because I think we're probably running out of time, I think, do you want to have a few kind of closing remarks and comments? And then we'll close.
Yeah, I'm just going to reiterate what Nick said. I think it would be really useful, interesting actually for us to know what kind of tax analysis are you guys doing in your PBOs? What's the what kind of data do you have? What kind of relationship do you have with the ministries of finance and the tax agencies? How easy is it for you to interact with them, and again, do they respond to requests from you for data and for information? Mm-hmm. How often do you get a chance to, have meetings with? Is it like formalized that you will have regular meetings with, say, the tax agency or the Ministry of Finance during a year? these kind of things would be very useful and interesting for us to know. So yeah, that would be very interesting. And then finally, I put my email in the presentation so that if any of you wants to reach out and have a specific question, please do so. Thanks.
Great. All right, before we close, just a quick reminder that we will be having a few webinars in this series that we will launch today. Please mark your calendars for the week of April 24th for our next webinar on gender budgeting. So there will be more announcements coming from you later as well, and from our EPBO platform. And I think with this, I think Mitch, I'm not sure if you need to make any more comments, but we'd just like to thank Rajul again for agreeing to offer this great presentation, and we will make sure to follow up with that survey and incorporate some of the questions that Rajul just mentioned there as well. So thank you all. We will have the recording of this presentation. So the recording and the presentation itself be uploaded in the EPBO platform that most of you are part of. So you can just go back to the presentation whenever you can. So thank you all very much, and we will see each other. We'll see you in the next webinar in a few weeks from now. Thank you.
Yeah. Thanks, everyone.
Bye bye.
Bye-bye.
All right. Great.